Good morning, and I'm so happy to be here. This is really a great opportunity to talk with you and to hear your questions. So I'm going to share my screen and then we will get started. So we are going to talk about alternative metrics, but what's really important about these alternative metrics is what they accomplish. Do they illuminate investor insight, or do they lead people astray? So what we're going to do is we're going to begin. These alternative metrics are called non-GAAP measures. I'm going to tell you what that means here in a little bit. And as I just mentioned, there are very different views, sometimes violently held views. I think they're misleading. I think they're just allowing us to con people. No. It's really important that we have these alternative measures because they remove things that we shouldn't consider in reflecting future performance. Sometimes you could get into some serious arguments about this. Now, what we're going to talk about here is what goes on in the process of dealing with these alternative measures. Now, these are mainly accounting issues. Now, do accountants have a place in the MBA program? Of course they do. Accounting is critically important. And in the MSBA, and of course, in the Master of Accounting. So when we think about accountants, what we think about is the fact that they are the people who keep financial markets safe. Now, that sounds like a very bold assertion, but I believe it strongly. And so what happens is the accounting folks are the ones who keep the financial information flowing, make sure that it is correct, make sure that we can rely upon it. Now, the US version of making sure all of this happens is managed by the Securities Exchange Commission. And the Securities Exchange Commission manages these alternative measures or non-GAAP measures. So what are they? Well, they are numerical measures of a registrant's historical or future performance all right, now I know there's a lot of words on the right-hand side of the page, but basically they exclude things that are usually included, and they include things that might be excluded. Now you see that term GAAP? For those of you who have a background in accounting, you know what that means. For those of you who don't, it means generally accepted accounting principles. And so what that means is those are the rules that we use to try to make sure that financial statements, when you look at the first company and the second company and the third company and the 101st company, that they are all using the same sorts of rules to calculate their net income, to report on their wealth, and to report on their cash flows. So what happens is the SEC is in charge of these non-GAAP measures. And examples of these non-GAAP or alternative performance measures are listed at the bottom of the screen. You may have heard the term EBIT, earnings before interest and taxes. You may have heard EBITDA, earnings before interest, taxes, depreciation, and amortization. You see that third one, adjusted earnings? Oh my gosh, adjusted earnings can mean anything, all right? Core earnings, adjusted revenues, free cash flows. These are some of the alternative measures. Now, why do we care about these alternative measures? I mentioned the term generally accepted accounting principles, and we already have all of those rules, but these alternative measures are being presented by companies that are not generally accepted accounting principles, and that's why we call them non-GAAP financial measures. So what that means is that all of the folks who work in the accounting profession and all of the auditors work very, very hard to create really, really solid information. And then the companies come along and say, I think we're going to make adjustments to that, and we're going to present those items as well. Those are the non-GAAP measures. So a little bit more about that. This is technical terms, but for those of you who are interested in regulation and in the securities markets, they should be very important terms. So these are the things that the SEC does. They have regulations, and on the left block, you'll see that they have a Reg G for non-GAAP measures. And then they have their regular regulations, SK, and they have made different rules about these non-GAAP measures. Now notice, the SEC has not said, thou shalt not use non-GAAP measures. They haven't said non-GAAP measures are bad. They haven't said non-GAAP measures are evil. What they have said, which is their standard operating procedure here in the US, is that if you're going to use these measures, then what you want to do is you want to disclose enough information about them so that no one can sort of feel misled. So in the middle block, you'll see here what kinds of things you have to disclose for these measures. First of all, you have to show the comparable GAAP official measure, all right? You have to start with that one. So you can't just sort of make stuff up and put it in a document somewhere. You have to start with the official audited GAAP measure. And then, oh, this is a beloved thing. Then you have to show a reconciliation. So if you want to show a non-GAAP or alternative performance measure, you have to start with your, say, net income. And then you have to show all of the adjustments you make before you get to your alternative measure. That's what Reg G requires. Reg SK and then our 20F things say that you have to disclose your GAAP measure with equal prominence. You can't just put it in teeny tiny little print at the bottom and then show your non-GAAP measure in a big bold print at the top. And you have to actually justify why you're using these measures. Okay, so now, but that wasn't enough. So this came out, oh gosh, I think in like 2004 eventually, sorry, at the beginning. And there were all these questions. There were so many questions from users, from preparers of financial statements, from analysts, from finance experts. So the US, the SEC, created these things called C&DIs, or compliance disclosures and interpretation. And so these are a series of Q&A information that allows companies to go and try to figure out how they should present this information. Two important sentences at the bottom, two very important sentences. In the US, the SEC enforces this. So if a company comes in and starts doing crazy things with their non-GAAP or alternative performance measures, the SEC is the one who writes them a letter and says, you're not doing that. You can't do that, and you have to fix it, and so forth and so on. So the SEC is the enforcer. Now, the second sentence at the bottom is also critically important, and we'll talk a lot more about that in a little bit. The non-GAAP measures are not audited. Financial statements are audited. That's part of what makes them reliable. That's part of why people can use them with confidence. But these non-GAAP measures are not officially audited. I want to give you an example. All right. Those of you who are interested in any of our 3 degrees will find yourself faced with financial statements. You will, if you look in the middle, you will find yourself faced with financial statements such as the income statement, called here the statement of operations. On the right, you will be looking at a statement of cash flows. And what I don't have here is a balance sheet, but that's okay. And then on the bottom left, you will see a whole bunch, many pages of notes to the financial statements. It makes you want to cry sometimes, but that's okay. These things are very, very important. Up here in the upper left is an example of what I've been talking about. It's an example of a reconciliation for the non-GAAP measures. So look at the very top item there where it says net income or loss 5.6. That is the GAAP measure. Okay, notice that it's negative. All right. No, now go to the bottom, adjusted EBITDA. That is their chosen non-GAAP measure. They chose that measure. They view it as meaningful. They think it's going to be meaningful to analysts, to other users, investors, etc. Notice 167.3. That's interesting. So there is quite a big gap there. So the measure that these folks chose, I want to emphasize this because we'll talk about it a little bit more later, is EBITDA. And then all of these items in the middle are the adjustments that you're going to see people making, all right? So, for example, they went back and they sort of adjusted for income taxes. They adjusted for interest. They adjusted, step down, depreciation and amortization expense. Why do they do this? They do this because, in many cases, analysts believe that this number here at the bottom, the 167.3, is more useful in predicting future earnings than this GAAP number at the top. Now, again, you'll have a lot of argument about this, a lot of argument, but still, that is why companies do it. And then companies in a particular industry will all start doing similar kinds of non-GAAP measures, not completely. Now, why are all these little boxes on the slide? Well, the reason is that we have to think about these adjustments, not just what measure did they choose, EBITDA, but we have to think about the different adjustments that they choose to make. And if you want to think about whether or not these are reliable, one of the ways that you can do that is by seeing if you can trace them to financial statements or to the notes. For example, look at interest expense. You see that, 44.9? Come over here in the middle, and right about in the middle of the consolidated statements of operations, you will see that number, 44.9. Okay, so now I have a little bit of comfort that at least I know where that number came from. Look at the depreciation and amortization expense up on the top reconciliation, 115.6. Okay, well, where is that? Where is that? Okay, look clear to the right for the statement of cash flows, and you will see, yep, there's that 115.6 near the top. So what happens is, if you can trace these numbers, and if you can feel like the numbers that are part of the adjustments for the non-GAAP measures are indeed audited numbers on the financial statements, then you may have more confidence. But you know what? They aren't always like that. So it might be that you will have a reconciliation and it will show depreciation, it will show some number, and you can't find that number, all right? You can't find that number in the cash flow statement. You can't find that number in the notes. You can't find that number. And that is because they have made adjustments to that number. I'm not saying that that's necessarily bad or evil, but it is the fact that you are going to have less confidence in that number if you can't find it somewhere else. So this is just a simple, straightforward, believe it or not, example of a non-GAAP measure. Let's go ahead. So as I said, we have to discuss the measures. One of the questions about the measures is where they're reported. In the US, these measures are reported in the MD&A, the Management Discussion and Analysis, which is not part of the financial statements. They are disclosed in analyst presentations and sometimes in earnings announcements, all right? So they're disclosed in a lot of different places, and it matters where they're disclosed. If something is disclosed in the financial statements or the notes, then it's part of the audit process. If not, it is not part of the audit process. Okay, what types of measures? We've talked briefly about that. I mentioned the idea of adjusted earnings. So if you see someone who is reporting adjusted earnings, that basically means it's whatever they want it to be, okay? They've taken their net income or net earnings and they've adjusted it, okay? So that's not an official term. It's not defined under generally accepted accounting principles. It's just something a company uses. We've also talked briefly in our example about how transparent are the reconciliations in the sense of whether we can find the adjustments. But sometimes that reconciliation that I showed you, which is very detailed, has line by line things, sometimes that is not very clear. It will just say net income, adjustments, adjusted EBITDA. Well, that's not very transparent. And that's one of the goals that we have in accounting and financial reporting, is to be transparent so people can use it. Okay. And then what is the impact of the measures? Now that one is kind of interesting. We've done a whole study on this, and I'm only sharing this one result with you about how non-GAAP measures impact. You notice in our example that it went from -5 to like positive 100 and something. Well, so how many companies report non-GAAP measures that are greater, that are bigger numbers, more positive? You see a lot, whether we're talking about US companies that file 10Ks, international companies that file 20Fs, or other international companies that don't have anything to do with the SEC. A lot of those non-GAAP measures are bigger and more positive. Then one of the questions is, now I showed you the example where we went from a negative to a positive. So how many companies do that? You may be thinking I'm going to say a lot, but actually not so many. So about 12 to 14% actually move from a negative GAAP number to a positive non-GAAP number. Again, what kinds of adjustments? What do we need to think about with regard to these adjustments or exclusions? All right. What kind of things? You saw some examples: interest, taxes, depreciation, amortization. Other things that companies will use for these adjustments are stock options. If you know anything about stock options, you may know that companies get, a lot of people don't think stock option expense should be on the income statement, so they'll add it back. How transparent are the adjustments? We've talked about that. And then what is the impact of income-based measures? Those are all questions and issues. All right, so concerns. I'll circle back to the concerns. All right, one of the concerns about using non-GAAP measures is that adjusting a component of the income statement, that they might be just really trying to meet some benchmark. They might be trying to meet some goal so that they can get bonuses, the internal people, or they might be trying to meet some benchmark that analysts have set up for them. In other words, it's not that they really believe this non-GAAP measure is the right number, but we're trying to meet some benchmark. A second thing is we can, because there's not a lot of regulation around this, we can see non-GAAP measures being calculated differently from one year to the next within the same company. That's kind of frowned upon. So then we can have non-GAAP measures that lead to comparability problems, not only within one company over time, but also you can compare different companies. One company might say, this is EBITDA. Another company might say, this is EBITDA, but they calculate them differently. So we do have some inconsistency going there. Now, this last one, if you're not in accounting, you probably won't understand, but most of the, well, no, that's not true, some of the folks that are really, really concerned about these numbers are concerned because the accounting folks make a new rule where they think it's going to report, say, revenues more clearly, more reliably, etc. And in fact, they don't. And in fact, these non-GAAP measures really decide to undo those things. They decide to reverse out. All right, now, very quickly, this is a very, very interesting issue. Internationally, this is an even bigger challenge. Why? I said that the SEC basically manages this process and regulates it in the US. There is no international regulator. So internationally, we have many countries with many different regulators, and they have different definitions of non-GAAP measures, if they define them at all. They have different requirements for the reconciliation, and they have different restrictions. So the folks who set accounting standards internationally is the IASB, the International Accounting Standards Board, and they decided to address the use of these measures. And I have Mighty Mouse there for any of you who know Mighty Mouse, because here they came to save the day. All right, now, the Primary Financial Statements Project is basically, this is a very simplified version, but it's basically going to require companies to disclose their non-GAAP measures. Where? Remember I said disclosure was important. Where? In the financial statement footnotes. And that includes the reconciliation. So instead of just disclosing it all over the place on your website, in this, in here, nope, it's going to have to be in the financial statement footnotes. And this means that non-GAAP measures would be audited. They've never been audited before. And so for those of you who love Scooby-Doo, so the answer to that is a ruh-roh. What does this mean? This actually is a very, very big issue. And so now we're going to hear from Professor Moyers, who is going to share with us from the perspective of an auditing expert, how to think about these things. And the first question that we have for Professor Moyers is, what are the challenges in auditing a company's choice of non-GAAP measures?
Well, thank you, Kim. And before we talk about this question, let me first talk about what is an audit. So Professor Smith talked about the fact that when companies have stock traded on a securities exchange, they have to file financial statements for the investors to see, and those financial statements are required to be audited. And that includes the basic financial statements and all the information in these footnotes. They have to be accurate and they have to be complete. And so they're giving an opinion that they're an independent auditor, that they're giving reasonable assurance that they're fairly stated in accordance with some accounting standards, which in the US is US GAAP, which in international markets, it might be International Financial Reporting Standards. So those things are audited by the auditors. And so she talked about the fact that maybe in the future, this non-GAAP measure might be in the footnotes, which would make them subject to audit. Now, the first question here is, well, do auditors currently have any responsibility with respect to these non-GAAP measures, right? Because they're not in the financial statements, so we know they're not audited. But how you may or may not know that any information that is included in a document that includes the audited financial statements is required to be reviewed by the auditors. So if these non-GAAP measures are in the 10K, in the management's discussion and analysis, the auditors are in fact required to read them and determine whether they're inconsistent with the financial statements. And if so, are required to report that to the board and to the audit committee and to get that resolved. So there is some very limited current responsibility for auditors with non-GAAP information if it's in these documents, but it's very, very limited. So if we were to move to having these measures audited, it would be a substantial change in the assurance that third parties would have in relying on this information. So the first question here is, well, what if the auditors were asked to give an opinion not just on the calculation itself, but on which measures a company decides to show? And so if you were to look at different companies, you'll find many companies have very different kinds of measures that they show. Even companies in the same industry may be showing different kinds of measures. One may be showing an EBITDA reconciliation, another one might be showing something called free cash flow. And so the question is, well, what's the challenge if the auditors say, well, we want you not only to audit the accuracy of the information, but to audit that the company chose the correct measures. And so that, you can imagine that would be very challenging for several reasons. One, we do not have a framework. For accounting standards, we have these generally accepted accounting standards that tell us guidelines. Now, within current accounting standards, there are alternatives, right? We have different methods that we can cost inventories. We have different methods that we can use to depreciate assets, but we have guidelines that we can, as auditors, can apply to decide, are they applying the appropriate choices? So it would be very, very challenging. So to have the auditors give an opinion on the choice means that someone would have to come up with a framework of definitions of measures that would be appropriate in certain circumstances. And that might also mean limiting the number of choices that were available to companies if you're going to ask auditors to audit those. And I think the other thing that Dr. Smith talked about was consistency between companies. That would have to be part of the process. So I think it would be very, very challenging to think that auditors would be asked to opine on whether the company chose the correct measures.
Thanks a lot. I love that word, opine. Every once in a while, I would say to my children, I'm going to opine on your behavior, and they would just roll their eyes at me. So you have to remember that. That's a very important word. Question 2 is, what are the challenges in auditing a company's adjustments that they use to calculate their non-GAAP measures?
Yeah, so this is a little more doable from an auditor standpoint, right? If you're saying, okay, you've got this measure, let's say there is a definition of that measure that somebody has put out that's consistent. And right now, there are no consistency. I think Dr. Smith talked about EBITDA, which people generally understand how that's calculated. But I think in her research, you'll find that different companies include and exclude different items to get to EBITDA. And so in auditing adjustments, there's sort of two pieces that an auditor might be asked to do. One is, well, is that adjustment, can you agree that to the company's records? Does that amount that's in the measure agree to the company's records, and is it accurate? And that would be relatively simple to do for an auditor. But more importantly, the question might be, did they include all the appropriate adjustments to the measure? In other words, did they include all the items that should have been included? And did they exclude any items that should have been excluded? And so again, that is something that an auditor could do, but you would need a framework or a definition of what that measure should be, and would be a fairly significant expansion of the auditor's responsibility to get that done. One of the things that the SEC guidance talks about is, what's the definition of whether an item is recurring versus non-recurring? And they have some guidance that says, well, if it's expected to happen again within the next couple of years, or it's happened in the last 2 years, it's probably not non-recurring. And so if you had some guidelines like that, you could then audit these things. But it gets back to things that Dr. Smith talked about, like stock compensation. Well, stock compensation is required to be included in financial statements. Why is it appropriate for that to be an adjustment? And that would have to be also factored in. The other question that some people have raised is, do the accounting standard setters have the jurisdiction to mandate non-GAAP measure definitions? Do they really have the authority to do that? And I think that also might be something that comes up at some point as they move forward in these decisions.
Thanks so much. Question 3 is, so overall, what are the pros and cons of auditing non-GAAP measures?
Well, I think with anything, and you talked about this before, that having transparent, reliable financial statements are the core of any effective and efficient capital market, right? And so having information that can be relied on, and the reason that you're able to rely on audited financial statements is because you have an independent auditor who's giving an opinion, some assertion there that the financial statements can be relied on. And so you don't currently have that with non-GAAP measures. So certainly having that measure available to the public means that you would have a higher level of trust and confidence of stakeholders in that information. It would also likely result in more discipline in management process. They knowing that it would be subject to an audit means they'd be a lot more careful about the way they prepared those measures. The other thing that it would help ensure, and you talked about this before, is it's not only important that these measures are appropriate and accurate, but they're consistent across time from period to period, and that they can be compared between different companies, because as people are evaluating financial statements, they're not necessarily looking at them in a vacuum for a single year, but looking at trends over a period of time or comparing multiple different companies who are competitors in the industry. And so I think it would also, encourage consistency and comparability to those measures. Some of the downsides might be that to make these measures auditable means we need to come up with definitions and a framework. And so that might mean limiting the number of measures that are available to companies. And so there might be fewer of these measures available if you're going to require them to be audited, and that may or may not be valuable to stakeholders if they're looking for other kinds of measures that management may use. It's also, there also is a feeling sometimes that if once an auditor puts an opinion on financial information, that, and particularly with non-GAAP measures, that financial statement users may think that that's a stamp of approval, that this is a good measure to use to measure the company's results, and may over-rely on measures that may or may not be the right measures to use to value the company or to evaluate the results. The audit opinion doesn't say you should use this. It just says this information has been subject to procedures and it's accurate in some level. And so that could also be a downside.
If you like this video, click the bell icon for more such content.